Hey guys, welcome to the video. Today we're going to be talking about a recession, if it's likely to come in the future, as well as some um, evidence or data they've collected, and then also what people can do if they want to, you know, prepare for this. I didn't see that guy. Okay, first we'll talk about what a recession is. It's just a period of reduced output, economic output, like growth, and then a significant increase in the unemployment rate. That's from the RBA, Reserve Bank of Australia. And you might ask, why are there recessions? Like, why do we have them? Can't people just avoid them? Well, they're actually part of the business cycle, which means they're needed. They can be seen in some perspectives as clearing out inefficient companies and jobs. The economy has been expanding for a while, as seen in the graph, which is seen that every quarter since 2021, there's been growth. There's a few, um, it's not the case. It's the overall trend has been growth and upwards. So right now, at any point in the time, the economy, as always, can keep expanding or it can contract, which means there will be a recession or a market correction. Um, the business cycle has four aspects. First, there is the expansion until an economy reaches the peak. That's where the economy grows until it reaches the point where it starts to decline, and that means it starts to contract until it hits the trough, which is like the lowest point on the recession, market correction, whatever. That's the lowest point. Then it goes to expand. Because you see how it's like a cycle. Either we're growing until we reach the top and then go down again, or we go down until we reach the bottom and go back up. Right now, we're in the growing until we reach the top. It's been quite a long expansion coming from like COVID, and it's been a big one. Like we've been growing, economy's expanding for a long time. I'm gonna chuck something up on the screen. This is the graph, so you can see that at the end of COVID, there's like that massive negative line of negative growth, and then it's been like expanding since then. So we've kind of cemented now that the economy will either expand or contract from this point. Now I start talking about why I think it will contract. As mentioned earlier, the recession is indicated by high unemployment rate, and as seen in the graph I'm going to put up now, the employment rate is not as high as in 2020. Like that, that's because we were in like almost a recession then. Um, but it's been growing. Like there's like a upward trend, and that's with like the limited data that we have. Um, since as a jobs report showed that there's actually more jobs missing than we actually previously thought. Um, the Arizona University State Seidman Institute uh, showed that there was job growth was at 0.45%. So out of the entire economy, is only 0.45% jobs being created. Like that's really close to just like being negative. With less job growth, more people are looking for jobs and can't find them. So people who don't have a job can't find them, and then people who, you know, already have a job, there's less likely for them to move up. They kind of everyone's just holding their jobs. Um, this is kind of shows the Gen Z kind of in like the brunt of this, where 46% of Gen Z workers in the US get money from their retirement accounts for daily living. Now that can also be, their wages are low compared to other people, but it's also harder for them to get jobs. Um, Key defense of the stock market, the not a recession happening, is that the stock market, is just continually going up, all-time highs, every now and then. Um, so people would argue, why would there be a recession if the stock market's pumping? Um, and the reason I have for that is that companies are buying back their own stock in buybacks. This pushes up the price of the stock as people see the stock price rising because this company spends, millions of or $100,000, buying their own stock. And I think that the company has, insider knowledge or they're just really confident themselves, but really they just want to push up the stock a bit to make more profit. Um, this shows like a trend in short-termism as well, but we'll get into it in a different video. Um, a stock price depends on how many sellers and buyers there are. When sellers are greater than buyers, the price goes down. When buyers are greater than sellers, it goes up. Um, Most of the growth in the US economy, I'll put a graph up around now, is the top 10 stocks in the S&P 500's growth. Um, and those are the companies who are mainly pushing up their stock performance with buybacks. Um, it's 10% of the companies with 74% of the growth, and then these companies, their growth is only because they are buying their own stock. Um, with private equity and companies continually buying stocks, this pushes the market to keep growing even when it should not be. It stimulates growth. No, it simulates market growth, but the economy is not actually growing. There is no reinvestment into research, and no new products are being made. A market crash is just a readjustment in the valuation of the stocks in the market. Lots of stocks right now are overvalued due to the phenomenon shown above. This also furthers the idea of a recession. People argue the recession can happen due to stock market rising, but the stock market is evidence of economic output rising. However, if there's no actual growth, such as this case, where companies are buying their own stock to push up their stock price, instead of researching new products, this misleads the economy and investors into thinking there's growth when there's not. Okay, put the image up now. The S&P 500 in the US economy. Uh, Unemployment is rising, economic growth has slowed, and more people realize this alludes to the fact that we're going to have a recession. Um, there's also talk about the top 10 companies are the AI stocks, another bubble kind of there, which kind of leads to people thinking that there's going to be a recession. I need to grab a gun. Fuck, that guy's a rat. All right, so another way to tell if the market's overvalued is the price to earnings ratio. A price to earnings ratio is a way to measure what the value of a company's share is. This is calculated by dividing the share of a company by its annual earnings per share. It is used to determine whether a stock is overvalued or undervalued. Bloomberg assesses the S&P 500's price to earning ratio at 27.40. If you bought one share of the S&P 500 right now, you would have paying $27.40 for $1 in current earnings. I thought my teammate bro, his name tag right behind him. While we're having this small breaks, put it down in the comments what your favorite Call of Duty is. I'm actually new to this one. Um, Obviously you can see that with 8 kills and 14 deaths, but back to the vid. The S&P 500's 10-year PE ratio, so that's like PE ratio, but the 10-year ratio, like the average, is 37.1. This is 80.9% above the modern market era average of 20.5. This suggests that the market is strongly overvalued. Just I can't look at that. Overvaluation is a bad sign and often means that there is a bubble, which means that a recession needs to happen to cut back and just reevaluate things fairly. I should have won that. Um, I'll put a graph up now. It just shows that consumer confidence and unemployment both are just like kind of working together in this regard. That people are unsure, because they don't have jobs, security is low, so they just don't want to spend too much money when they could have like not much money in the future. Um, where is everyone, bro? There's also I've used the Buffett indicator. This is something that Warren Buffett uses. Just give me a second. What the fuck? The fuck did this guy go? All right, well, put about him. So that's the total U.S. stock market value divided by um the gross domestic product or GDP of the economy. So right now, the total stock market value is 65.47 trillion, while the analyzed GDP sorry, let me just clutch. Is 30.15 trillion. So that means it's 217%, which is incredibly overvalued. Um, it's approximately 68% above the historical trend line, which, you don't want to be above. That just ow. If the stock market values grow much faster than the actual economy, then there may be a bubble. How should you prepare? Well, first things first, if you have a diversified portfolio, you'll feel um, the brunt of it a lot less, as some sectors can be hit harder than others. This guy is pissing me off just running around like this. And other aspects depend on your income, assets, and job security. If you can pay for your next 6 months of living expenses, you're in a good situation and you can probably stay invested. Um, where's this guy shooting me from? Think about how many bills and stuff, like just rent, food, water, utilities, just even discretionary spending, um, that will affect, you need to be able to pay all this. And if you cannot, you need to take it out somewhere, either get a loan or if you've got investments, sell your investments, to stay alive. So, therefore, if you've got less than 6 months of living expenses saved up in an emergency fund, you should start working on that and then don't have loss in the stock market. Where was that guy? I would start taking stuff out now, like stocks, because it's all-time highs. So if you've invested, you'll still make a profit ideally, and I wouldn't be investing now, as you'll be a lot less likely to make a profit in the long run. This is if you're have a low That's not good. A low emergency fund or none. Also, if you have a high job security, like if you know in a sector that will not lay off, even if a recession occurs, then you'll be a lot better off. So I'm just like locked into this shit, bro. Um, so if you've got 6 months, really expenses saved up, you've got good amount of assets, and you've got good job security, you should consider staying invested. This is because you'll be able to weather the storm, so to speak. So you better stay invested long enough, and you don't have to take it out. And so you'll end up, being better off, as you can wait for it to dip, then it goes back up again in like 2 or 3 years, and then you're just living your life just waiting for it to go back up. The signs that I've shown in this video, what make me consider that a recession will occur. I have no idea what that guy was. This piece ignores politics, just because I don't think it's that you should focus on. Then it could be like a potential massive video about every little thing. If there was something that you disagreed with in the video, let me know. This is just like a couple of days of research, not like a massive deep dive. I will be buying less stocks. I've got a few big expenses coming up that I need to have money for, but I do have some money invested in that I invested like a while ago, so I'm just gonna leave it there, and then I'll probably buy more after. Like I'm basically going away for a while, and that means I'm gonna need money when I'm over there. So I don't want to invest now and then have to take money out. Just to remember thinking about all this doom and gloom, remember the words of US economist Paul Samuelson. Wall Street indexes predicted 9 out of the last 5 recessions. So like every YouTuber, economist, and TikToker you've probably watched has been saying there's a recession coming and everything's so bad, but it could generally just not happen, and that's just how it is sometimes. Like as I said earlier in the video, the economy could just continue expanding. It's unlikely, but it could be. So just play it safe. Yeah, just get your emergency fund, have diversified portfolio, and yeah, thanks for watching the video. Leave a like and a comment. I'll see you in the next one.